set up about 10 years ago, and specifically with a mission to focus on local capital markets, mobilizing private capital from local markets into infrastructure in Africa and other developing markets. We don't just focus on Africa, we also cover Asia. And the thesis really behind GuarantCo was you have a lot of players looking at providing dollars. A lot of the DFIs at the time were very much focused on providing long-term dollars into infrastructure. And there wasn't really a champion in the market looking at how do we bring local currency financing into the equation for infrastructure in Africa. So with that sort of mission, GuarantCo was given was brought to life, and given the mission of basically creating that champion and making something happen. I joined GuarantCo about 9 years ago, and I was sent off wide-eyed into Nigeria as my first market to try and make something happen there. And we did. In 2011, we did the first local currency corporate bond outside the financial sector in Nigeria, which was for a company called Tower Aluminium. And that whole process was was both encouraging and also brought home the challenges that are faced in terms of mobilizing local currency. And I know some of the participants on the previous panel touched on that. It just so happened that the lawyer on the opposite side working for the client was actually the gentleman sitting next to me. And through good faith, actually, we're back here again sitting at the table, this side on the same side of it. What Tower Aluminium brought home to me was that, firstly, there was massive potential as well in Nigeria. The pension funds are sitting on something around $20 billion of liquidity in local currency. The majority of that, pretty much I'd say 98% of that, 99% of that, is actually going into government treasuries. So none of it is actually mobilized into infrastructure, but it could be. So the question in my mind was, how do we do that? And the other question I had is, how do I do that when Nigeria is only supposed to be, 1/6 of my time? Because I'm meant to be covering many other countries, and really that's not going to push the needle in terms of what Nigeria needs. Through a number of happy coincidences, I was introduced to the Nigerian Sovereign Investment Authority. And they too were thinking about this idea of how do we mobilize pension funds. And the idea came to the front of, let's create a Nigerian GuarantCo. And then we then basically worked with the NSIA through the support of the Private Infrastructure Development Group that GuarantCo belongs to. We got technical assistance funding, and through additional support from some of our donors like DFID, we were able to basically put together some development capital and start InfraCredit. And having sort of developed the concept, we looked to recruit a CEO, and through a happy coincidence and a very long process, CHINUA came to the forefront. CHINUA, what was it that, from your perspective, attracted you to the opportunity of InfraCredit? Why do you think this was an idea? Because within the Nigerian context, it was completely a startup. Credit enhancement is something in Nigeria which isn't particularly well understood. What was it that you felt presented itself as an opportunity that attracted you to come and want to do the role?
Thank you, Lars. Good afternoon. Well, I think if we look at so my background has been worked in investment banking in Nigeria for 10 years, and mostly in the DCM space, and that exposed me to working with corporates, subnationals, and raising corporate bonds and state government bonds as well. And I was also involved in setting up 1 or 2 development institutions. So the experience basically showed that, one, we have relatively developing debt capital markets, because that's a very important factor if we're looking at local currency long-term financing. Also, Nigeria is estimated to require about $3 trillion over the next 30 years to finance its infrastructure deficit. It's estimated that we require about or $25 billion per annum to bridge that gap. And the budget, capital expenditure on the budget is barely 25% of the annual demand. So clearly, the demand for private sector or additional forms of capital indicates that there is certainly a need for local currency funding to help bridge this deficit. And so, as last you rightly noted, we've got a pension fund. This is a country with 180 million people, growing at an annual rate of 2.6% per annum. Also has one of the fastest urbanization rates as well. And the demographics, we've got about 50% of our population 30 years and below. And so it just demonstrates the growth potential and also the opportunities. And so looking at these broad figures and also having the benefit of also operating in that market, it was clear that there was a need to connect infrastructure financing to the long-term local currency market. And so, what InfraCredit set out to achieve now is basically to support the first, what we consider our first bond issuance, which should happen hopefully before this year runs out, and begin to unlock what we consider as a potential for long-term infrastructure financing. So, in context, the pension funds can invest 35% of their AUM in infrastructure and infrastructure, corporate bonds and infrastructure bonds. That translates to about $6 billion. And that only 1% of that is in, less than 1% of that in infra-related assets. Recently, again, by chance, the rules have been changed to also sort of force them to begin to diversify their portfolios very quickly, because some pension funds have hit their single limit by having over 80% in government security. So there's clearly a need for the pension funds to actually diversify away from heavy dependence on government securities, and they're searching for a new asset class that is long-term to meet again their portfolio, because it's a growing. Our population effectively means that the duration of capital you hold is an average of 30 years, 25 to 30 years. And so there's a mismatch on their portfolio, because when you look at the domestic debt capital markets, even though it's sized about 8 trillion naira, which 90% of that is government securities, but there clearly is a corporate bond market. So there is an opportunity to create a new asset class for the pension funds to hold, and so there's a demand. In terms of the deal flow, we have boots on the ground, and so we increasingly are seeing transactions that are plagued by short-term borrowing from the banks. And the other thing, again, with the banks is Basel III effectively is compelling, forcing banks not to lend longer, and their cost to lending is also increasing. So the banking sector is not providing the required long-term money. The rates are pretty high and the tenors are very short, and so this creates a mismatch. And I think in the earlier panel we did talk about the devaluation risk, especially in countries like Nigeria, and there's now a need to ensure that there's a matching of revenues against your liabilities. So what we see here is an opportunity to unlock about $6 billion of Naira equivalent. So let's say that this is about 2 to 3 trillion of local currency funding that otherwise can go into infrastructure if the assets are well structured, bankable, and so for me it was an opportunity to take on this role and help prove the concept, which is what we're hoping to achieve.
So you make the point about projects that are bankable, and do those projects exist? Because we've heard on the previous panels that there's a question mark over that.
So our model for the first year, we would look at operating assets. So for the initial phase of operations, actually, we're focusing on brownfields that have predictable cash flows, and strategically makes sense to be able to turn around deals much quicker and demonstrate how this entity will operate and the opportunity in the market. We have set out initially to identify these pipelines, and within the first year we've signed 2 mandates. We've got 1 deal through our credit committee, and we're increasingly looking at more pipelines. So in terms of deal flow on the brownfield side, we're seeing existing transactions that are creditworthy but are constrained because of their capital structure. We certainly understand that the deficit is significantly in new projects that need to be executed. But one of the constraints as well that affects the bankability, or I would say even new projects coming on stream, is that these investors don't see an exit as well. So the banks would lend short term, which affects the capital structure and impacts on the ability to pay on these projects. And so the transactions we've seen are basically refinancing 3-year loans on a 15-year asset into matching tenors of 10 years with the corporate bond. So we think that the success of our initial operations will unlock the potential, because then we begin to see more deals come to market with a clear exit in terms of having that access to long-term local currency financing. I think one of the key constraints that our market has faced over time is a mismatch in funding and also in tenors as well. So this has actually affected even the way deals have been structured, and therefore we may appear that it's not bankable, but the capital structure has been wrong for most of these transactions. So there is a potential, and we certainly expect that with the first deal that unlocks value for other transactions.
Okay. I mean, in terms of the projects that you've got in your pipeline, where do you see the most interest in Nigeria?
So power is a real constraint. So we've got, like I said, a population 180 million, and we typically would say that rule of thumb is, I think, it's 1 megawatt per 1 million people. So we need about 180,000 megawatts of power. We only produce less than 5,000. And self-generated power, I think, is estimated about 15,000 megawatts. So there's a constraint in the band in the electricity sector, which requires one of the major constraints is really in the grid, which is impacted by tariff constraints and also connections constraints as well. And so there is an emerging market for the captive embedded power, which is not exposed to the risk that the grid has. So we see a huge opportunity in that sector, because that really unlocks what we consider the supporting environment for other sectors to evolve, because the lack of power has been a significant constraint in the cost of doing business. So that is one sector that is an increased interest, especially the captive embedded power sector. Hopefully with the grid it's resolved, with the current restructuring going on, that becomes attractive as well. Transportation is becoming, again, an area of interest, especially within the Lagos metropolis. There's a lot of investment the Lagos state government is making in transportation, so we see that sector potentially evolving as well. And then the ports is also looking interesting, and then the airport recently there was an announcement of concessioning. So these are sectors that are showing increased interest from the market. But we're looking at initial deal flow is targeted towards the power sector. So we're hoping to close first or the second transaction in the power space, and then begin to diversify as well. We're seeing transactions in the ports sector as much as also transportation, and then hopefully we could do other things like power as well.
Yeah, I think the power sector is especially interesting, because one of the things we're seeing is a lot of demand from existing projects and clients in the power sector in Nigeria looking to refinance out. A lot of them have borrowed in dollars significantly. And in fact, I think it's fair to say the power sector in Nigeria is dollarized now. But what we're also seeing is, somebody mentioned, I think Martin mentioned earlier, with the commodity price drop, particularly in the oil sector, Nigeria is suffering a liquidity shortage in terms of credit dollars, and that is massively impacting the power sector. And what we're finding quite interesting is now that it's also meaning that a lot of international lenders and DFIs are retrenching and sort of waiting to see what happens next before they actually move forward. And what we understand is the World Bank's solution is to try and pump more dollars into the sector, which may or may not restore the situation in the short term, but the question is in the long term, does that really make it different? So from our perspective, we feel that there is a need to rebalance first the power sector and then largely the economy in Nigeria, which is very dollarized, by encouraging the availability of local currency funding. When something is not available, then people go to what they think is available, which is dollars at the moment. And really what we're trying to do with InfraCredit, work with InfraCredit to achieve, is this rebalancing. I'm going to stop there and just check. Are there any questions in the audience at the moment? Yes. Okay.
So, do you think one of the problems is the actual valuation level of the naira contributing to the dollarization of the economy?
The valuation level?
Yeah. The current exchange rate.
It's not a problem if you're borrowed in naira. So I guess it depends on how you want to look at it. The real issue is if you're borrowed in dollars and your client, if you assume you're a lender, is earning in naira, then it becomes a real big issue. Another way to ask the question that you asked is whether the interest rates in naira are also too prohibitive and make dollars more attractive. And actually, we've done quite a lot of work that actually over a 10 to 15 year horizon, which is really the horizon you should focus on for infrastructure. Local currency, interest rates, when you factor in devaluation, are probably at best the same, if not less expensive than dollars in the long run. Any other questions? Okay. So just going on quickly, John, what is it? And I'm tempted. I know there are some pension fund managers sitting in the audience here, so I'm tempted to pick on one of them, but I won't do just yet. But the question is, what do you think are the challenges InfraCredit faces in terms of encouraging pension funds to invest in infrastructure debt?
So one of the risks at the early stage set of things for InfraCredit was market demand, market acceptance of the facility and ability to price credit enhanced debt instrument. So we set out very early to engage with the pension fund operators. I think the key constraint for them clearly is that they haven't been investing in any of in this sector, and so they don't have the capacity in terms of analytical capacity to analyze this sort of asset class. And as fiduciaries, they also want to maintain capital preservation and don't want to take much credit risk. So I think there's a balance between not willing to take credit risk and also the capacity to analyze this asset class. And so what we've done, working closely with our development partners, GuarantCo, is to initiate capacity building program. So alongside, we've been working closely with the pension funds to expose them to infrastructure training and co-due diligence. And so we believe that out of this process that they would first understand the credit appraisal process we undertake as guarantors in analyzing this credit risk, thereby increasing their understanding of the underlying assets. And so initial deals will wrap full, because they also indicated that they would want a full wrap initially, and over time they could begin to share risk and we could do partial wraps when they have a better understanding of the asset class. And so so far we've had it's been very favorable response from the association and the individual members. They've been also very active participants in the capacity building program. I think we're looking forward to closing our first transaction, and hopefully that really sets the path for the future of infrastructure and financing in local currency debt capital markets. Because if we can't get in the pension fund, I really don't know who else is going to invest.